This is about the laws of numbers. If I can calculate in a credible formula mathematically what the potential for default is, and I'm the huge investment bank, and I can create an image that says I know what I'm doing, and I take this to the rating services, and the rating services look at these thousands of mortgages in a single security, they start making an assumption that the mortgage companies and the banks actually did their work. And they surely wouldn't question the genius of a huge investment bank. This is about how many hours in the day do I have. This is too big, and I'm not going to be embarrassed by saying I don't understand this. Right? Little wonder when things get complicated, people kind of gravitate back to the one area that we typically would rely on, and that's the Treasury market. And it's the only investment there in the United States that is a direct obligation of the Treasury, is Treasuries. Everything else is either an implied risk of the government or it is an act of Congress that created it, including FDIC insurance. That's not all. So they figured the smoke and mirrors thing, if you want to use those terms. But then there's this derivatives market. That's called a derivative, but it got even more complicated because now you're doing all kinds of swaps. And that whole derivative thing of interest rate options, foreign currency options, let alone the commodities market, which Larry would talk about, and this leverage. You know, we've all heard about stock options, et cetera, and real estate options, but the leverage on this thing is where hedging takes place to offset risk, and to do that there has to be a speculator on the other side. They offset one another. About 60% of the derivatives market outside of commodities is not traded in the United States. It's traded in London. And London clearly has positioned itself as the investment capital of the world. Now, that may surprise some people. So what we're looking at here is a market that's truly international. And then throw on top of that trying to insure this stuff. And throw on top of that a factor that no formula possible could have thrown in here. And those of us that deal with clients, both institutional as well as individuals, have something that we understand thoroughly. And that is the human factor. We were talking earlier, there's only one thing really that has any value in any social economic system. It's human knowledge and human opinion. And you throw emotion on top of human opinion, especially the fear factor. And folks, we are in the midst of, at least in my lifetime, the greatest fear factor example that I can ever imagine. What do? If you don't have a process in place in regards to your own understanding of risk management, then you will be victimized greater than you already have been victimized. If you've got it in place, you understand what your risks are, good times and bad times, you still have been victimized. Because no matter what asset class that you've gone to, every one of those asset classes has been affected. The bond market's been affected, the real estate market's been affected, the commodity markets has been affected, the derivative markets are being affected, private enterprise has been affected, and of course the stock market's affected. But you have to have a risk tolerance in place that has been predetermined by you. Well, I can tell you most clients have done that with good advisors. The problem is that nobody understood the potential that was here with this much leverage and how we're so interconnected internationally. This fear is something that we have to deal with, and it has to be dealt with in a stable fashion. It has to be dealt with somebody who has the patience to do this. In the early 80s, we had this crisis in a much smaller degree. John's going to be talking a little bit about how that the banks are having to mark their securities to the market. But they had a solution back in the early 80s because they were allowed to spread out over time a much more reasonable solution. The government was thinking about bailing this thing out, but in reality, it's not a bailout. This is called stabilization, and if we don't get some kind of stabilization done, people are going to be hurt even more. I dare say that if I ask you to raise your hand, how many people in here have a great concern? It would be silly for me to ask the question. You're here.
30 seconds. Thank you. Thank you, Michael. I appreciate it, and we will come back to you again to get some more opinions about what will be the best way to achieve the stabilization and what individual investors should look at.